But Philip, thank you very much for your time this morning. Floor is yours. Click here there. Thank you.
Great. Morning, everyone. Philip Short from Flagship Asset Management. I think important to point out is that we are globally first focused on, we first focused on global investments and portfolios. Our first portfolio was launched in 2001 out of Cape Town. And I think it's very important for South Africans to have exposure to global markets. So the JSE, or all the companies on the JSE, have a combined market cap of 1% of the total market cap in the world and 4.4% of the world's GDP. So it's not just to people that are in South Africa that I say this to, but people that are in Australia, Mexico, Japan. You've got to invest globally. And you can do that from South Africa. You can do it from rand-based accounts, like with Flagship. So bearing that in mind, a lot of what I'm going to be talking about has a global focus or a worldwide focus. Okay, so markets are pretty expensive, or very expensive. If we look at the All-Country World Index, or the ACWI, it's trading at a 19 times forward PE, relative to its 20-year forward PE median of 14.7. So it's about a 30% premium. On the next slide, I'm going to show you something similarly, but by geography. So first, just look at the left bar, that's the US, and if we look at the red bar, that is showing you the range of the forward PEs where the S&P 500 index has traded over the last 20 years. But to exclude outliers, I've just used the 10th to 90th percentile. So we can see over the last 20 years, the S&P 500 has traded at a 12 times minimum PE and a 21 times maximum PE. The white dot is the median forward PE over the last 20 years, and the blue dot is the current forward PE for the S&P 500 index. And that is in outlier territory, so it's in 90th to 100th percentile. So certainly very, very expensive relative to its own history. Next to that is ACWI, the All-Country World Index, also very expensive. Europe, Japan, and China, slightly less expensive or moderately expensive. And then South Africa, they're the only one with the current forward PE, which is below its median PE over 20 years. Now, importantly, valuation should never be taken or seen in isolation, because markets can stay more expensive or very expensive for much longer than one can anticipate. And sometimes for good reasoning as well. There might be very strong underlying earnings growth, or the interest rates might be coming down. So the last time I spoke at a BCI conference was in April last year, and I showed the asset allocation of our worldwide flexible fund. And that would be on your left. And that was the 31st of March. So you saw a 73% equity allocation globally, 7% gold and cash 20%. On the right, that's updated to the end of July. That equity allocation has gone up from 73 to 84, and that's been taken from cash. Now, we've done that whilst generally markets have become more expensive. So the question is why? So we use a top-down and a bottom-up work, identified some really great stocks that got sold down in April and in May on the back of the tariff and trade war headlines. So that was the bottom-up work that we did. On the top-down, we look at a number of macroeconomic key points, but the one really important one was global liquidity, and that still screened quite favorably. Yeah, I've taken the S&P 500 index over the last 5 years and overlaid it with global liquidity. The global liquidity is defined by M2 money supply, and M2 money supply is basically just all the liquid cash that's out there. It's what's in your pocket, what's in the bank accounts, your savings accounts, your money market accounts, but it is not what you've invested in equities, in property, and bonds. So this is just sort of cash that's sort of slushing around. And you can see they track each other quite well. Now, if central banks cut interest rates or initiate quantitative easing, global liquidity goes up, and that's positive for equity markets. This is the same chart, but just going back 16 years to show you that the relationship still holds for over longer periods of time. So the question is, where to next for global liquidity? So if we look at the interest rate cycle part, this chart shows you where the world is in its interest rate cycle. Now, if I look at the red line, which uses the left y-axis, it tells you that the percentage of central banks whose last move was a rate cut as opposed to a rate hike is sitting at 80%. And then the gray bar is on the right axis and is the same data, but weights those central banks by the country's GDP. We're also working at about 80%. So you can see for the last year or so, central banks globally have been increasing, or the percentage of central banks have been increasing in cutting rates, which has increased global liquidity. So the important question is, where to next for global liquidity? So I think the US Federal Reserve is widely expected to cut rates later this week, probably largely priced into the markets. But now people are starting to expect an additional 1 or 2 cuts in the US later this year. So the risk is that although markets are expensive today, that they might be even more expensive come December. What we would be keenly looking out for is as that cutting cycle starts turning. Now you can still have that positive, let's say at 60% of world central banks cutting, but that delta which is negative means that there is a liquidity leaving the market, and that is negative for global equity markets. So it's something that we'll be keeping an eye on quite keenly. And for us, risk management is not just about avoiding the losses, but it's about participating in the gains as well. I remember one of the senior mentors that I had at Flagship, he's over 80 years old now, but he said, I think it was in 1990, 2000, markets were very expensive, and he sold all his equity holdings, and then the markets doubled from there. So, it's about having that experience and being cognizant that valuation doesn't drive 100% of outcomes. You have to look at different things, which is why we use top-down approach as well. Okay, interestingly enough, I didn't know gold was going to be such a focal point today, otherwise I would have brought a lot more slides with me. But as a fund, we are multi-asset, and you would have seen we own 0 bonds, but we are invested 8% in gold. And I think listening to a number of the people here, I agree with all the things that they say in terms of what's happening in the world, but the most important, and this is obviously my point of view, the most important reason for gold and where gold is going now, it is now the truly risk-free asset of the world. Shortly after Russia invaded Ukraine in early 2022, the West and the US froze Russian foreign reserves, including Russia's holding of US treasuries. That's US debt that they owned. So the USA froze that. They weaponized US treasuries by doing that, and in practical terms, they defaulted. The US defaulted on their debt by saying, we're freezing that, we're not going to pay that. And some of the Europeans were saying, not only are we frozen that, but we're going to take some of that money and we're going to give it to Ukraine. And straight away, you started seeing big players, especially the BRICS, selling down US treasuries, their holdings of US treasuries. And why? Because they might be next. And what you saw at the same time is central banks around the world starting to buy gold, and lots of it. Now, the slide I would have brought with me, if I had known it would be so topical, is to show you historically, gold has almost a perfect correlation to negative interest rates, US rates. So nominal rates minus inflation. When that's negative, there's no opportunity cost of holding gold, so people pile into gold. So when we saw that decouple in April, May in 2022, saw central banks buying gold but selling treasuries, we thought at that point in time was the Rubicon of gold taking over US treasuries as being the truly number one risk-free asset in the world, and which is why we'll continue holding it. We are 0% investing in bonds, which is pretty strange for a multi-asset portfolio or fund. And let me just start with the US debt. So we know that US has a spending problem and a debt problem. On my way here, flying from Cape Town, I saw that the August budget for the US They raked in $350 billion for the month of August, which is almost entirely from collecting taxes, corporate tax, income tax, $350 billion. And by the way, this isn't new. This is every month for the last 2 years or 3 years that I've been tracking it. What they spent was $750 billion. So that deficit of $350 billion has to be financed with what? It's debt. Okay, so, and now think about it, the other line item, the third biggest spending point after Medicare and Social Security and above schooling, education, and even defense was net interest expense of $100 billion. So they've taken in $350 billion, and there's $100 billion of that is going to paying interest on debt. And I've said this before, but they are in the situation, and it first happened now last year, where they've had to take new debt, which all countries and companies do, to pay off old debt or roll over debt. But this is the first time that they had to take out new debt just to pay off the interest on the old debt. So that's like me and you having a credit card to get through the month. We max out that credit card, but now we've got interest, and our paycheck can't pay the interest on that credit card. So what do? We take out a second credit card, not to pay off the debt on the first credit card, just to pay off the interest on the first credit card. So that we're staying away from US debt. Similarly, which has been quite an anomaly, since 2022, developed market debt volatility has been greater than emerging market debt volatility. The rest of Europe and developed markets are not far away from the US situation. So we're not touching DM or developed market bonds. We don't hold SA bonds, and SA bonds actually did pretty well this year, so well done if you held that. But our decision was to hold gold in our portfolio and not SA bonds. So we're happy with that decision. So what we're watching, also we're very active, and what we do is we do a lot of our research not on what we see today, but what we expect tomorrow, so that when it does happen, we can react quite quickly. There's no point in saying, I think a recession is coming tomorrow. You make your portfolio, construct your portfolio for a recession, and then there's no recession because those things are very hard to predict. And then you haven't participated in any upside in the market. So we like to be as close to current data as possible and respond to data as it happens. But we respond to that data by having done earlier research on that. So the main things that most multi-asset managers will look at, you got there, inflation, US bond yields, rate cuts, etc. But the one that I'd like to highlight is, at some point, the market's going to correct. I don't think it's going to correct heavily due to the global liquidity by December. But let's say something happens next year and the market's correct. I wouldn't be surprised if we see some sort of QE, quantitative easing, or yield curve control out of the US, which is going to flood the markets full of money, which is going to get that global liquidity coming up again. So my go-aways are, market could still get more expensive from here into December. I don't know what's happening in 2026, but looking at valuations where they are, we could see a good correction. Post that, be ready for any liquidity that's being injected into the market. Our biggest tool is risk mitigation at Flagship. We have designed some tools that allow us to let our winners run for longer, and we'll cut our losers quicker. That does mean that we'll usually have a higher turnover, but we'll rather cut a position that's down a certain percentage point at the risk of holding it and losing more money. Over time, the best performing asset class is equities, or are equities. So we usually have somewhere between 65 and 95% of the fund in equities. We're unconstrained, it's flexible, so we can hold 0% in any asset, we can hold 100% in any asset. It's a worldwide fund, so we can hold 0% in South Africa, or we can hold 100% in, name a country. We're nimble, we can act very quickly. Like most people here, we are boutiques. But playing in the global markets, you even get to be more nimble. So if you do own Meta, we can sell within a second without really moving the share price. We're truly global. So most of our peers who now manage global money, most of our South African peers, they first started cutting their teeth investing locally, and then once they got maybe too big for the local market, then they went globally. Our first fund that we launched in 2001 was a global fund, so that is in our DNA. And we have a 21-year track record, 24 track record, having started in 2001. And then the last slide, We've outperformed our benchmark since 2001. JD Hayward, the co-manager, and myself, we took over management of this fund 2 years ago, and we've continued the good performance of outperforming the average of our peers and our composite benchmark. And I'll leave it with that. Thank you very much.
Thank you very much.